Let's get a view on what's happening out there. Alastair Schultz is joining us from ACY Securities in Sydney. Alastair, welcome to the program. We haven't really delved into the Bank of England and negative rates so far this morning. Do you think that that is a likely route the bank will go down, considering we are now talking about Brexit as well?
Look, I think when it comes to the Brexit side of things, there's a lot to contend with. For me, them trying to go for negative rates now would be well and truly too early. Until they really get resolution around what's happening with Brexit and actually have a solidified answer as to which of maybe the four pathways that I see available to them actually go, it makes it really hard. You can't go backwards again on the interest rate at that time. So, if they do it now, it means that they're really leaving themselves, shooting themselves in the foot or cutting themselves short for what might happen down the track. So for that, I'm really going to be considering, that they don't go forward with it. I think that just the talk is maybe a little bit of jawboning action for now, but it would be way too soon for them to really push through with a negative rate, especially when the Brexit sort of decision is looming around the corner. Unfortunately, for the Brexit side of things, though, we have seen delays over and over and over again. So I think they're going to have to really hold off until they really have firm action on that.
Yeah, shooting themselves in the foot, that's certainly right. They're like cutting off both their legs with this process. Even, I think, Joe Biden tweeting last night and giving Boris Johnson a real rap across the knuckles for his indecision and for the way that he seems to be flouting international law by going back on a deal that he has based his entire career around. So give us the worst case scenario then, Alastair. If this Brexit falls through, if these negative rates get tossed up, where does Britain go and what happens to the pound sterling?
Look, I think the best way to look at it for now would be to see what's the worst case scenario we see with the Brexit things. There's really only four options that I can see that stand out to me. The first one is that they do get a deal, they're happy, they walk away over the rainbow, and they get some level of a free trade agreement that works for both parties. The next one is that you might consider this as maybe the second and the third option, is a deal that is similar to what we see here in Australia and something that we might see in Canada. But in both of those instances, we have been consistently trying to negotiate better terms with the EU for a number of years. So that doesn't, whilst that is a better scenario than the absolute worst case, that is still something that means that they're going to have a lot of work ahead of them to sort of resolute to. The worst case scenario in my mind is they walk away with nothing. They have no deal, they have nothing in place when they turn around. And from that perspective, if you look at sort of their export numbers, their import numbers, and general profits that they might make towards their GDP from the international trade, it's already been speculated that over the next sort of 15 years, we might see a reduction of about 10%. So that side of things does sort of scare me. If they were to then move with this idea of cutting their rates off or cutting the legs off short, as you said before, then you are going to be running into problems that you're not going to be able to support the economy really much further. Once you go negative, it's very hard to go back, as we've seen with the EU already and what we've seen in Japan. So for a number of years, that addiction to stimulus will continue to grow, and the valuation and that rate advantage that they've really got left on the pound would be decimated. So you'd be left with this rate advantage that they've really the last thing that's kind of holding the nice pieces of the UK together disappearing very quickly.
Alastair, we've got New Zealand's market opening lower. We're expecting a risk-off session here in Australia today. It's been risk-off in the US post-FOMC. That's as the Fed continues to buy $120 billion worth of bonds each and every month. Is this a realization on behalf of investors that, the taps are going to be open for a long time, but, some of these companies and their high valuations are going to have to be justified when it comes to earnings going forward?
Absolutely. I think there's a couple of things there's a lot to really unpack with the US situation, regardless of how you look at it. And I think in today's segment, we really wouldn't have the time to really get into all the intricate details. But for me, they're signaling that with the projections that we saw earlier in the week about rates being extended and staying near zero until at least 2023, with very few members suggesting that there might be a rate hike in 2023. Really, anyone who is investing in equities should be giving them a round of applause or at least buying them a beer, purely because they've now got to guarantee that they're going to be seeing basically really cheap prices and the ability to refinance any debts that they do have for an extensive period of time. And it's sort of generally accepted that when you do get rate cuts or you get monetary stimulus, it does tend to bring down those real yield values. And of course, it increases those risky asset side of values as well, which if you actually look at the most recent Bank of International Settlements report, their quarterly report, they did try and quantitate what's really been going on, how much of the sort of stimulus and the quantitative easing measures that we've seen in 2020 have supported towards the rallies that we've seen across the entire stock market. And for me, the final conclusion was that after you'd gone through all the math and the numbers, and of course there are a lot of assumptions that you have to sort of take for granted, but in that that report, they suggested that perhaps more than 50% of the rally has really been driven from just the responsibilities that we've seen from the central bank. And to me, that is a little bit concerning because it does increase that want for addiction of more stimulus to come down the track. And then the question always has to be asked, what happens when you cut it off? You're going to be cutting off the stimulus, therefore you're going to be cutting off a lot of the liquidity and the funding. You've got a devaluation on your currency values, and it's overflowing into other markets. So all of that is going to be something that's going to be highly problematic when it eventually comes round in time to actually increase rates and start tapering off some of the policies that we have now.
Hey, Alistair, let's just bring it home quickly. Macquarie in focus this morning. Looks like they've got a deal going over in Italy. We've got numbers coming out for the poor old Sydney airport, and of course Fonterra over in New Zealand putting in a decent return today. Which of these issues are you following the closest?
I'm personally following the New Zealand situation quite closely, especially with their dairy trade and how much that sort of price index has been manufactured. I do like looking at the dairy price index a lot, and of course New Zealand economy has seen their largest contraction year over year that they've in pretty much all time, or for what we've seen at least from the Great Depression or as long as records go back to sort of 1977. So a 12.4% year over year reduction compared to what we've seen on their GDP figures for a while is concerning. And it was a little bit deeper than they were expecting. And there is a lot of price points that we're sort of looking at to say, okay, well, how much of this can we equate down to their very short stint but very hard lockdown? And are they going to be able to really get out of that? The biggest concerns that I see for that moving forward, obviously I'm more on the side that Australia's probably going to outperform on the recovery side than what New Zealand is, purely because of how difficult they're really being with international trade and allowing people in through their borders, which naturally over the whole scheme of things really will impact their ability to sort of get that recovery happening, get their consumer spending up, and of course get their GDP right where you want it to be.
And the ASX today, we're in for a rocky start, it looks like. There's nothing that will necessarily turn that scenario around through the day as far as any expected risk event on the Asian horizon. You think we'll just sort of bump along waiting for the US Open?
Yeah, I really do. I think today's session is going to be rather subdued. I think people are really going to be considering what's happened in the US market overnight, particularly with what we've seen on the S&P and the NASDAQ, with tech stocks sort of hammering down again. And of course, they're still really considering what implications the FOMC and the Bank of England is really going to have on us and the rest of the world. So for that side of things, that might affect a little bit of our ASX market today, and people will be more interested in seeing what's going to come out tonight.
Hey, Alistair Schultz from ACY Securities. Thanks again for coming in. We'll talk again next week.
Thank you very much for having me.